signal now. So whenever you're ready, Samantha.
Yeah. Hi, everyone. I'm delighted you could join us today. My name is Samantha Taylor, and I'm the head of research at iFi Global. Today is the second of our now regular LP allocation reviews, which we are doing with AI Raise, who specialize in collecting data from LPs around the world. They track 66,000 LPs thanks to their AI technology. We'll be doing these reviews of allocations to the alternative stroke private asset classes every 2 weeks with them. Before we get into the main discussion, my colleague Simon Osborne, the CEO of iFi Global, is going to give a brief overview of developments in private credit and why we believe the prospects for this asset class look very bright. We very much welcome your questions and plan to allocate a few minutes before we close for them. If you have any questions, please do use the Q&A button at the bottom of your screen. We plan to finish at around 12:45 EDT. And I will now hand you over to Simon.
Thank you very much, Samantha, and welcome to everyone around the world who's joining us. As always, we have a big cross-section of countries when we do these things, and we're delighted that you can all be there today. My name is Simon Osborne. I'm the CEO of iFi Global, which is a research and media house based in the City of London. We have 3 monthly publications and 1 weekly. One of those monthlies is Alternative Investment Strategies, AIS for short, which we are doing as a joint venture with AI Raise in order to provide LPs with analysis of what's happening in each and every single different private asset class. And we do believe quite strongly that a lot of change in at least some of those strategies is coming up over the next couple of years, especially as we'll get into it in a minute in private credit. We are with Larvin and AI Raise. We are doing these online events every 2 weeks now. And in addition to that, we will shortly start doing one-on-one interviews with GPs who are subscribers for our soon-to-launch GP directory and e-library. So welcome to you all. I'm just going to make a few opening comments. I'm planning not to talk for more than just a few minutes, just to set the scene, and then we're going to get into the chat with Eric Hernandez and Larvin. If you could turn over the first slide, Samantha. Thank you. As I say, this is just a bit of brief scene setting to begin with. As I've already mentioned, I think there's going to be more change coming in private credit than perhaps any other of the alternative asset classes, and there will be change in the other alternative asset classes too. McKinsey put out a white paper very recently that said that a new era is coming for private credit, partly because of changes that are happening in direct lending, but also the fact that lending is now diversifying into other areas as well, particularly into a variety of asset-based financing structures. And also there is an expansion of the sources of capital that are coming in to private credit at the same time as that. Assets at the moment are at or just shy of $2 trillion. BlackRock forecasts that they will go to 3.5 trillion by the end of 2028. Moody's said recently that the CAGR of the strategy overall since 2021 is a very impressive 18%. Schroders did one of their big institutional investor surveys late last year, focused, I think, on pension funds, and 51% of those that they surveyed in that category said that they will be increasing exposure to private credit in this year alone. It is, according to Schroders, as is private credit, the second most popular private asset class that there is with the institutional investor community. Next slide, please, Samantha. I decided to put this up on the screen because I think this is unique or certainly unusual in comparison with the other strategies that come under the umbrella of private assets strategies or alternative strategies. It's just the wide variety of structures that are used in private credit. And there you have it. This is from Private Debt Investor. Just only 40%, according to them, comes from funds, 15% from co-investments, 12% from secondaries, 10% direct, 10% fund of funds, 9% managed accounts, and the remainder is a variety of weird and wonderful different sources. But it is an extraordinarily broad and diverse areas or structures that are used. And finally, my last slide of the day is coming up. I just wanted to do something a little bit over the horizon before we get into the general chat with Larvin and Eric in a second. That in my view, and I think many other people's views as well, the future is very bright indeed for private credit. In addition to the reasons we are about to be going into in some detail, I'm going to throw through two items at you that aren't immediate, but we think will come along towards the end of the decade to really make a difference. One is tokenization. It's still early days in the illiquid alternative space for tokenization, but it is definitely beginning to happen. And there's, according to one source we looked at, there's $500 million of assets tokenized right now in private credit, and that is forecast very strongly to grow very quickly indeed. A lot of people think tokenization will really take off this year and next, and if it does, private credit, at least in the alternative space, will be probably the fastest or one of the fastest growing categories that there will be. And secondly, and this is further advanced, and it's a different thing altogether, but it's definitely worth mentioning, sustainability. A lot of people, including myself, think we're going to see yet further growth in sustainability in a whole variety of different areas over the coming years. What I find very interesting is that one of the ways, not the only way, but one of the ways that is happening through private credit. It's a very popular way to get into in some of the sustainable areas, using private credit as a way to develop assets in the sustainable or some of the sustainable sectors. Those are subjects: tokenization, sustainability, and private credit. You could have a whole webinar just on those subjects. I'll just leave that as it is for now. And I'd like to bring Eric in, who is the managing director of Secured Secured Debt Investments. He's MD Capital Markets there, and he's also been with Atlantico Capital Partners, Alsis Funds, Deutsche Bank, Standard Bank, Baycoma. He's got 20 years experience in asset-based lending. We are delighted to have you here, Eric. Welcome. Any initial comments you'd like to make to start with, in terms of where you see the category that you're in terms of its development today and development over the next couple of years?
Yeah, well, first of all, thank you, and welcome everybody. Good morning to those of us in the American continent. Good afternoon, good evening to the rest of the world. And Simon, very interesting initial comments that you provided. I think that yes, generally speaking, you know, in the current environment where we're seeing a lot of geopolitical risk, a lot of uncertainty coming from the U.S. government, people are going to increasingly look more and more into private credit and other alternatives as a way to mitigate those volatilities while still obtaining good risk-adjusted returns. And you know, that's what we have been focusing on for the last 15-16 years, and we'll talk a little bit more in detail throughout the rest of the session.
Okay, and I'd like to bring Larvin in, who's the CEO of AIRaise. As I've already mentioned, we are partnering with AIRaise and with Larvin to do these discussions on a very regular basis. He raises capital using his AI techniques for GPs around the world by tracking 66,000, I think it is, Larvin, LPs that you have. Over to you.
As 66,000 LPs, 150 data points accumulate to nearly 10 million data points. Our AI is calculating in split seconds. It's a much faster approach to find the right investors. Eric is one of our clients, and the investors we spoke to were super interested in what they're doing. I personally am a friend of Eric and big fan of what he have achieved so far. Not only with SDI, but also his personal development. And I think he can give us today some insights, what he has learned in these large corporations, such as Deutsche Bank. But on the same time, being a small and growing asset manager, he has a strong operation. So he has built a strong operation with his team. And this is what those LPs, the limited partners I'm speaking with and who are today in the audience, want to know a little bit more. Why don't we structure this call as following? Eric, I'm interested a little bit more into your personal background. What have you done at Deutsche Bank? Where have you seen these investment opportunities? And what is the difference between working in a large bank and then going to a specialist asset manager with the focus on real estate?
Yeah, absolutely. So I started my career several months ago working for larger financial institutions, BBVA, Deutsche Bank, Standard Bank. And I started my work focusing on project finance transactions as well as securitized products transactions, right? So focusing on RMBS transactions, CMBS transactions, securitization of future flows, where the asset originating those flows was a water treatment plant. It was the the tokens from a subway system in the city of Sao Paulo, for example. The early years of my career, I focused on Latin American transactions, and then eventually made the switch to U.S. transactions. A little bit further down the road, I made the switch from working for large financial institutions, finding a company that needed growth capital, and putting them in touch with an institutional investor through a publicly traded or a publicly issued transaction, such as debt capital markets, asset-backed securities transaction, and going into the private side of things, working for Alsis Funds, which is a credit investment management platform. And what I found was, and that's when I made that change from working for large multinational financial institutions to smaller opportunities. And what I found is, that yes, there's a change in the terms of the infrastructure around you, right? The smaller shops, we don't have very large trading floors where we sit with 50, 80, 100 of colleagues and peers, but the principles stay the same. You have to be very good at your analytics. You have to have really good relationships with your counterparties, and you have to have very good systems that allow you to properly manage the ongoing processes that you have. If you have all of those, then the most likely scenario is that you're going to be successful in whatever endeavor you have. And so working for those large transaction institutions and learning those best practices, translating them into smaller entities, has allowed me to help grow this for whether Alsis or now that Secure Debt Investments.
That's very interesting, Eric. Thank you so much. Can you please describe what you guys do at SDI in full, and what kind of offerings do you have for institutional investors such as pension funds, but also especially the family offices, single family offices, multi-family offices, those who want to invest into funds, those who want to invest directly, because we have quite a lot of a few hundred family offices who have joined today into this webcast. They are very often interested in your operations.
Yeah. So our investment strategy crosses two segments. One of them is the credit side of the business, right? We focus on credit opportunities. The other one is real estate. We're focusing commercial real estate. So what Secure Debt Investment does is it deploys capital in distressed debt opportunities that are backed by commercial real estate in the USA. Okay, we focus on on a niche of a small balance transactions. Every time that we deploy capital, we're making an investment that can range anywhere between 5 to 30 million of capital deployed. Okay, and we will always focus on the most senior part of the capital stack. We will be looking at the loan portion of an opportunity. That loan portion is going to be in distress. It can be fully non-performing. It could be some performing because it has reached some covenants, right? Or it could be performing, but it has a short-term maturity, and the current lender doesn't want to hold it in the balance sheet. So we will take a look at those opportunities, and we receive a lot. And through our process, we'll focus on the ones that we really like, right? Then do an analysis, get to those with high conviction, determine what's a proper asset management strategy for that particular investment, price it accordingly, and then go to market to compete for that. We work with both large institutional investors that have given us capital to deploy on their behalf, as well as with family offices and high net worth individuals, all of them accredited investors, right? They don't exactly play in the same space, but they do come alongside on the different investment vehicles that we have for them. In terms of one of your questions, hey, we have family offices that want to deploy capital, that are looking or are very interested into this space. I would tell you, wholesale loan investment is slightly different than your traditional commercial real estate, your traditional real estate investment. Traditional real estate, you take a look at an asset, you like the asset, you put it under contract subject to the diligence, right? And then you have 30 to 45 days to do the diligence and complete the transaction. Whole loan sale secondary market is the other way. You will be granted access provided that you're a bona fide player in this segment, because it's not open to the general public. You will get granted access to information and the pertaining materials relating to a particular asset. You will have to do your due diligence beforehand and then come with a price to the marketplace. And you might get it, you might not get it. If you get it, then you have very small reaction times. You have 24 to 48 hours to come in with a hard non-refundable deposit, and 5 to 7 business days to complete the transaction. So slightly different way to participate in this space. And for family offices looking to start working in this, they need to either have the infrastructure and the technology in place that allows them to do this as we do it, or participate alongside an experienced operator in the market that can help them, get access to this kind of opportunities.
Yeah, operations is probably the key word here, but I want to go a little bit more into detail. But before we do that, let me put myself into the shoes of the LPs. On a day-to-day basis, we are speaking to a number of LPs for and on behalf of our GPs such as you. And the LPs give us information about where they have invested in the past, where they want to invest in the future, what is currently very interesting for them. So I've selected 5 LPs or limited partner investment strategies. Let me give you some information of them, and please pick those LPs and tell me why you think they are then interested in private credit and real estate private credit. So let me start with a UK family office. It's basically a single family office with 2 successful German entrepreneurs. They're based in London. Their assets under management is around 3 billion pounds or $3.25 billion US. They're currently focusing exclusively on venture capital, obviously because of their background, but also private credit strategy, which is not so much their background. Then we have a German fund of funds who give me a lot of information about what they're doing. They're basically independent, globally active, a specialized fund investor in the field of alternative investment. focused on infrastructure, private debt, and private credit. Their assets under management is at the moment at around 10.8 billion US dollar, or 11.7 billion, 10.8 billion euro or 11.7 billion US dollar. And their investment remit can be summarized as following: infrastructure, so equity investment into core plus, and opportunistic strategy. Private debt, so your area, first and subordinated loans for SMEs, specialty lending and distressed debt. And then private equity, special situations such as restructuring and carve-out. And they also have a strong ESG focus. So you can see the private equity field, special situations is already something they have always done, and now they also jump into the private debt market. Another LP is a Middle Eastern family office. So it's a subsidiary of a Middle Eastern conglomerate managing investments. Functioning as a single family office, the firm's primary objective is to broaden the group's investment portfolio by diversifying into various asset classes. They're a little bit bigger with $25 billion assets under management. And they have a broad investment remit with a strong focus on real estate and credit. Credit just recently. So now you might want to think, why is that just recent? Then your neighbor, an American fund of funds with offices in New York, Germany, UK, and Spain. The firm is an independent global active specialist fund investor in the field of alternative investment, focused on infrastructure, private debt, private credit, private equity, and venture capital. Their assets under management is in the range of $20 billion. Be precise, at the moment, they are at 19.4 billion US dollar. Their investment remit in private credit is focused on middle market senior direct lending funds and opportunistic funds. So you see again the connection with the opportunistic is a bit more risk focus, and again they're focusing on higher returns. Finally, there's another Middle Eastern insurance company. It's a dominant insurer in Qatar, and it's the largest insurance company in the GCC by market cap and total assets, with $7 billion assets under management. They invest across the following asset class: fixed income, equities, real estate, derivatives, structured products, private equity, and private credit again. So you see some of those LPs have never been in private credit. Recently they started and they tell me, now I'm going to private credit. Lavin, give me more private credit GPs. Why do you think this is the case?
Well, I think it has to do, like I mentioned in the beginning, public markets, they have had fantastic returns in 2023, 2024, right? But exceeding 20%. But you can see that it's not uncommon for public markets to also have really big drawdowns, right? 2022, it was negative, it was negative over 15% in 2022 before the 2 years. So far, over the last 3 weeks, the market has raised the last 8 months of gains in public equities, right? So, there's a reason to say, hey, public markets, yes, they give me good returns, but I have to be willing and able to go through those really big drawdowns periods or even years, right? Private credit, by definition, it's gonna try to address those concerns, and they're gonna do it by focusing a lot of the times on asset-backed transactions, and it doesn't necessarily have to be commercial real estate or real estate in general. It could be backed by future flows from derived from a contract of very strong operators. It could be future flows derived from a very pulverized portfolio, such as auto loans, mortgage-backed securities or mortgage-backed investments. It could be backed by future flows of commodities, right? So by playing around with having an asset and therefore having at least two exits, right? If I don't get paid by the future flows that the asset is supposed to be originating, I can take control of the asset and sell it at a price. Yes, it's probably not going to cover me 100% of my principal, but there's going to be a backstop to that. I think that's part of why private credit can be so attractive vis-a-vis, just lending against a balance sheet, where if we continue to be, at least in the U.S., because the European Central Bank lowered rates last week. But if we continue to be for the foreseeable future in a high interest rate environment in the U.S. with a lot of uncertainty because of all the talks of, yes, we have tariffs, no, but we're not going to be having them. But yes, we have it, but it's reduced and it's only for 30 days. And then who knows what's going to happen. That's creating a lot of uncertainty. And in private credits, you're not exposed to that. You have longer time frames, so that mitigates part of those ups and downs.
Eric, can I just ask? Can I chip in here and ask you? Since you mentioned it, we talked about these. You mentioned the drawdowns that have been in equity markets just in the last few days. Just follow my hypothetical here. Let's just say we are going into a potential recessionary period in the period ahead, what people are beginning to call the Trump slump, or whatever name you want to put on it. Does that make you, let's just say for the sake of argument, you see that's the way things are going, whether you do or don't, that's another subject. But does that make you reconfigure what you might want to do in terms of lending money to a firm that's in the auto loan business or something like that? Because, credit, auto loan debt is very high in the US right now, and there's all sorts of other forms of debt which are very high in the US as well. Would you want to steer clear? Do you go into that kind of macroeconomic analysis in terms of what you do, and then go towards entities that might have commodities as a backup security? Or how do you configure that, if you configure it at all, is my question.
And please also consider that Trump is currently pushing towards lower interest rates. Yeah, how would you act? Yeah,
absolutely. So the question for that is, it depends, right? And it depends on what the GP is focusing on. So I can't really talk on behalf of other strategies. Let me talk on behalf of our strategy, right? For us, do we take into consideration macro analysis? Yes, because obviously that's going to drive the market, and that's going to have an impact, right? Assuming that, hey, we continue to be in this environment where you could potentially, you could already say that we're in a bear market in the public equities. You can say that, hey, at least for the medium term, the next 3 to 6 months, we're not gonna be seeing interest rate cuts in the U.S. That's gonna have an impact on valuations. And why is that a problem? It's a problem because between 2025 and 2026, you need to refinance about a little bit over $1 trillion of mortgage debt backed by commercial real estate. Okay. Now, granted, the vast majority of that is gonna get refinanced, and a lot of that is gonna be refinanced by some of my peers who focus on private credit. Hey, bank is no longer willing to refinance you. The Wells Fargo, the Citibank, and the Scotiabank of this world is not willing to refinance you. Hey, I'm an alternative lender. I'll give you another year. Why? Because I like the fundamentals of the underlying assets, right? So a lot of that is going to be served and well served by the private by the private market. And those firms currently are having a lot of volume and are doing a lot of really good businesses. Some transactions, unfortunately, they will not be able to be refinanced. Why? Because the sponsor has reached the limits and they cannot bring additional partners or additional capital to the table, right? Or they can refinance because they took a loan at 3.5, 4.5 interest rates, and now they have to pay 7.5. It's almost twice the amount of the monthly interest payment that they need to be making. And the way that that they had underwritten the transactions. They are, over the last few years, they haven't been able to raise rents at a 5% on an annual basis as they initially underwrote. So, you know, those kind of opportunities, those kinds of sponsors, whether they're being held by a bank, by a CMBS transaction, or even by a private lender, you know, if there's not another way, they will go into distress. And you know, that's really where we focus on, and that's our strategy. So from our point of view, that uncertainty and those changes in the market increase the number of opportunities. And from where we are sitting, it allows us to be more selective and on where we deploy capital. And those same $10 million that we were able to deploy in 2017, 2018, 2019, which were really good years overall for the economy, right? It took us a lot of time and a lot of effort to find really good quality opportunities. Now in 2024 and 2025, it's easier, and we may even be getting access to markets that beforehand was really difficult to access.
Eric, thank you for that. But let's go a little bit more into detail. Where do you see more promise within CRE lending, and why? Are there any regions or property types where you have seen particular high success rates and conversely higher challenges? Please give us your business secret for our investors who are in the audience.
Okay, so you know, what have we seen, generally speaking, in the marketplace since the second half of last year? We have seen a renewed interest in financial institutions and lenders lending into the marketplace, right? Multifamily and industrial continue to enjoy a lot of tailwind in that space, right? And at least in the U.S., there has been, you know, the Sun Belt across the whole nation has continued to be where the vast majority of new developments and new transactions have continued, right? Where do we see a little bit more problem? Currently, you know, office continues to make the vast majority of the headlines. It has done so all throughout 2024. It continues to do so. But you know, increasingly, we're also seeing that that multifamily, it's also bringing a lot of this stress into the marketplace. And for the very same reason that I said before, you know, these were loans that were recently underwritten, and for different reasons, they haven't been able to execute the business plan as originally envisioned. Other sectors, you know, they come and go. And like I said, generally speaking, I think that the future is bright. You know, over the next 12 to 18 months, it is expected that not only in the US, but globally, we will go into an environment with interest rates trickling downwards, right? And that's going to help credit. There are still very strong fundamentals, you know, for certain asset classes. You know, there continues to be a shortage of housing units in the US. That's also the case in certain countries in Latin America. That's also the case, as I know, in certain countries in Europe and even the Middle East and Africa, or even the Far East. So you know, there's going to be opportunities. Now, having said that, you know, not all markets are created equal, right? Not because, you know, multifamily has been a relatively safe haven. It means that every transaction is going to be a good transaction. No, actually, you know, right now it's from our current pipeline, it's probably the sector or the segment where we see the most number of opportunities. Maybe not the highest amount in total in dollar numbers, but certainly the most in number of transactions or potential transactions.
Well, the devil is in the detail, isn't it? In terms of commercial real estate, so post-COVID, we have seen exaggerated valuation corrections in the office space, the ones you just mentioned. Major companies like Amazon, Dell, Home Depot, Stellantis, JP Morgan, Tesla, Goldman Sachs, they all are asking their employees to return to the offices full time. And you know what? Scientific literature shows that working from home reduces the quality of innovative ideas as well as quantity of these. Sorry, Simon, sorry, Samantha, but please come back into the office, right? Like Eric and I are doing this. And on
We're
top
in the
of
office
there's
on Wednesday.
every day, Monday to Saturday.
Only Saturday afternoon. Hey, listen, sorry to interrupt, but I see we actually do have quite a lot of questions coming in. Do you want to ask one more kind of question, or should we to Eric, or should we go and see what the questions are and do with those what we will? What do you think? Should we go to the questions?
I have one question regarding the operations. So my assumption of a really good asset manager, and this is what I discussed with a couple of family offices, is independent of what the market is doing, whether it's rising or falling, if there's a good asset manager with an incredibly good operations, they're going to make money no matter what. What is your business secret, Eric? And apologies that I'm asking that again.
No, I totally I agree with you. I remember that a few years ago, one of my previous CEOs said that, hey, you know, even if you don't come in at the best pricing, if you have good asset management, you're gonna have a good you're gonna be making a good investment. So I totally
Yeah,
agree.
and what is your hands-on asset management approach?
Yeah. So, you know, from our side, you know, it starts at the underwriting process. When we're looking at an opportunity, you know, part of the analysis that the team has to make is, hey, what's gonna be the solution for this particular opportunity, right? Is it gonna be an amicable resolution with the sponsor that we can work out and resolve without the involvement of a legal proceeding, or we think that that's not really going to be suitable, then that's not really going to be the case. And you know, since the early onset, we know that, hey, we will have to go through foreclosure in order to take control of the asset, stabilize it, and manage it ourselves before putting it back on the market again. So and you know, those two major solutions, and again, you know, each case it's a tailor-made to suit, but generally speaking, those are two resolution strategies are going to command differentiated pricing. Now, having said that, you know, part of what we part of the secret, and I wouldn't call it secret, part of our practices that differentiate ourselves is, you know, our underwriting and asset management teams work very closely, and they even rotate within their responsibilities. Why? Because an underwriting that has to go through the pains of asset management and chasing payments or coordinating everything that you need to do once you have the asset on your balance sheet is going to be a better underwriting, and vice versa, right? An asset manager that knows where things can change and understands what are the critical variables and the critical levels that you have to manage your transaction is also going to be critical. So that's one of the things that we do. The other thing that we do is we have a relatively small assets to asset manager ratio. Why? Because we want to be very hands-on. We want asset managers to be on top of their portfolio every day and on a weekly basis, on a monthly basis. We have reports, they get analyzed with senior management. They get sent to our capital partners on a weekly basis, on a monthly basis, sorry. And every quarter at least, you know, we will sit down, or sometimes even more frequent, we'll sit down with our capital partners and tell them, hey, listen, this is a portfolio that we have in the investment vehicle. This is our original business plan. This is how much we have deviated. These are the corrective measures that we took in order to return to our target path.
And what were the results in terms of IRR? What you have been delivered to the LPs, or what is your target IRR for the current fund?
Yeah. So our target returns are 18 to 25% on levered returns in terms of IRR. Obviously that will depend. The safer an investment, it's going to be 18 to 20. The riskier an investment is going to be more 25 to 30% kind of results. Over our 15 years of history, we have realized 79 investment opportunities. Out of those 79, on 6 of them, we have either broke even or lost a little bit of money, right? Our average blended asset level IRR for those 79 investments, it's 22.5 on transactions that are 3 million and above. The average IRR at the asset level exceeds 30%.
That's very good.
Nice.
Can I just say, unfortunately, we are in theory supposed to be finishing in just a few minutes. We do have a number of questions. Should we have a quick stab at doing these questions? These things go very quickly. Samantha, do you want to read them out, and we'll try and do short answers to them, and
Yes,
not go too far over time?
So the first question is, will infrastructure be a growth area?
Eric or Larvin, what do you think?
My belief is I think so, and it's taking a particular. I was reading a report last week that was saying that infrastructure could potentially be taking over real estate, particularly for pension funds, insurance companies that have long-term investment horizons. So I do believe that infrastructure is going to be a growth area for the next for this cycle, and certainly for the next 5 to 10 years.
Thank you.
I agree. Infrastructure is growing.
Okay. So the next question is, can you explain why private credit will benefit from tokenization?
I can have a stab at that, but I don't know whether Larvin or Eric wants to have a go at that. Do you want to?
Go ahead, Simon.
Well, there's 2 ways. This is in seconds. Sorry, it has to be seconds. One is the standard way you put a fund on chain. That's one way. But what's really interesting, I think, in private credit, going back to what we wrote in the last issue of AIS, is that you can use a decentralized lending protocol to create tokenized debt, and that I think could really, really, really explode in the next few years. That will change the market considerably. I'll shut up on that.
I think I would like to add that due to tokenization, we might also receive higher dry powder, which companies such as Eric's can use and reinvest into that field. That's also what Apollo did with the ETFs, which they have launched recently, right?
Yeah.
Mm-hmm.
What's the next one, Samantha?
What is the reason for the high compound annual growth rate since 2021?
I think Eric's just basically answered. I mean, Eric, that's right up your street. You basically just answered that in your description of your IRR. Do you want to add something to that?
Yeah, like I said, it's a combination of diversification and pools of capital interested in increasing their allocation, just for enhancement of returns and diversification purposes.
Okay, so the next question is, what is the core element of the structure of the funds, the economics, pricing, tenor, etc., that allows you to play in the refinancing market space, especially in periods of increasing interest rate regime?
Good question.
Yeah. So, for us, generally speaking, we will take a look at what is the unpaid principal balance on the loan, right? But more importantly, we're going to take a look at the level of the collateral. Let me just give you a brief example of a transaction that's currently live for us right now. It's an office opportunity in Coral Gables here in Miami, Florida. And this is an asset that last transacted for 54 million, has a 49 million unpaid principal balance. We're coming in at a price in the high 30s, but for us, yes, it's a nice discount. But really, what we're seeing is, hey, for that particular investment opportunity, we're coming in at a price that puts us at around 50% replacement costs after all CapEx that we know that we need to make in the first 12 to 15 months. That's roughly around $250 per square foot post CapEx. It's under 180 pre CapEx. So with those numbers, it's that's where we have very high conviction, and by being able to source on the right and have really have good visibility on where the numbers are going to be, what we're going to be doing. That's how we can get access to these kind of opportunities. So that talks about pricing. Tenors, our investment vehicles usually have a 5-year tenor with 1 or 2 year extensions. The extensions are utilized only if we have 1 or 2 legacy assets that we haven't been able to sell within that 5-year space, to be able to give it a little bit more time and not have to do a fire sale of the asset. And I think that's probably the rest of the details.
I think we are out of time, right, Simon and Samantha?
Well, yeah, thank you. Thank you for rapidly getting through the answer so quickly, and the other ones. We've covered a lot of ground in a very short period of time. As always, the time has gone galloping by. We'll be coming back to this subject later in the year. There's going to be a huge amount to be said in various different areas, stuff we've covered here today. But maybe I should just wrap up and just say thank you all for following us. We will be doing another of these type discussions in a couple of weeks. That is back to what Lars and I did a couple of weeks ago, where we are going to be looking at the overall strategy development so far this year, covering the whole kit and caboodle. We thought that we're not going to be disappointed, a very fast changing macro environment this year. Doubtless the tariffs will be on and off about 3 times before we get to the next one of these in 2 weeks' time, and all sorts of other crazy things will have happened as well. So we will be talking about that and how it affects the private investment strategies. So we hope you can join us for that. And as I mentioned in my beginning, we will also be developing and announcing quite soon our online GP directory that would also go in the back of the publication, and also our e-library with interviews with our GP subscribers. So lots to announce, lots coming up. Thank you very much for following us. Eric, thank you for galloping through a lot of information today, and hopefully see you all the next time. Bye-bye, everybody.
Thank you. Bye-bye.
Bye-bye. Thank you.